Hello and welcome to this week's video on next week's FOMC meeting. The Fed will keep the Fed funds target range unchanged at 5.25% to 5.5% at next week's meeting. This is of course a widely expected outcome. The real question is whether the Fed only pauses or whether the rate peak has already been reached after 525 basis points of rate hikes. We are in the camp of those who think that the Fed is done with rate hiking. First, the labor market has cooled markedly. Job growth slowed and job openings fell. Lower demand for labor is also reflected in lower wage growth. Secondly, underlying price pressures continue to weaken despite the somewhat higher inflation rate in August, which is due to a spurt of gasoline prices. So, things are moving into the right direction from the Fed's perspective. It is of course surprising that disinflation has been so painless so far. Earlier waves of high inflation could only be broken by engineering recessions. This time around, there is at least a good chance of a soft landing. However, one should not yet declare mission accomplished. There are some warning signs after all. American consumers will probably be a bit stingier going forward. The savings rate has already dropped below pre-crisis readings and a further decline is unlikely. Fiscal policy will also see for some headwinds given extremely high deficits. And lastly, while much lower, inflation is said to be too high for the Fed's liking going forward. Thus, rate cuts are not to be expected before mid-2024. We therefore maintain our forecast of a mild recession for early 2024.